Good morning, students. Our next chapter is financial statement with adjustment. First of all, let's discuss the meaning of adjustment in preparation of final account. Now tell me, what is the basic objective of preparing financial account? Its main objective is to find out the actual profit and loss of the business and to get the financial position of the business for a particular year. And this is possible only when you record all expenses and income relating to that year in account. So, according to accurate assumption, revenue and expenses are recorded in the period in which they become due, irrespective of whether they are received or paid. So, in order to get the actual profit and loss of the business for a particular year, it is very necessary to record all the expenses and income relating to that year, whether paid or not, whether received or not, are taken into consideration. Clear? So, all items that are brought into books of account at the time of preparation of the final account are termed as adjustments, and journal entries passed to give effect to the required adjustment are known as adjusting entry. So, here are few adjustment which will we discuss today. Now see, first adjustment, that is closing stock. What is the meaning of closing stock? Closing stock means, see, closing stock means the amount of goods unsold at the end of the year. So closing stock is always known only at the end of the year, so it is not included in the trial balance, and its value is usually given as an additional information outside the trial balance. So how will we record the closing stock? Its two effects are, first we will record it in the trading account on the credit side with the name buy closing stock, and the second effect on balance sheet on asset side. Clear? Stock will be recorded on two sides, closing stock first in the trading account on credit side and second in balance sheet under asset side. Clear? Now the second adjustment is outstanding expenses or expenses due but not paid. And it's what are, first tell me what is the meaning of outstanding expenses. Outstanding expenses refer to the expenses which have become due for payment but not have been paid till yet. The benefit of these expenses can be taken during the year but their payment has not been made. So its adjustment effect will be, we have to add in the trading or profit and loss account in the concerned expense. For example, salary outstanding 1000. Salary are profit and loss expense. We record salary in profit and loss account. So we will add outstanding salary in profit and loss account in salaries. Means they will add either in trading or profit and loss account in concerned expense. They will add. And second effect, balance sheet liability side. We will record these expenses on the liability side of balance sheet as we have to pay in future. These are outstanding expenses. Then the third adjustment is prepaid expenses, or we can say it unexpired expenses, and another name is expenses paid in advance. Now what is its effect? This will be deducted from the concerned expense because these are not related to this year expense. We record only current year expense and income in profit and loss and trading account. So prepaid expenses are related to next year which we have paid in advance and they are not due right now. So the benefit of these expenses is available in the next accounting year. So we will deduct these prepaid expenses from the concerned expense, and the second effect, this is our current asset, will be recorded in the balance sheet or asset side. Then next adjustment is depreciation. What is the meaning of depreciation? As you all know, depreciation is a gradual and continuously decrease in the value of fixed asset. So this is also our expense, non-cash expense. We will record on the debit side of profit and loss account, and the second effect, we will deduct this depreciation from the concerned asset in balance sheet. We show all the assets in the balance sheet and the depreciation will be deducted from the balance sheet. Then next adjustment, interest on capital. What is the meaning of interest on capital? Interest on capital is paid by business to the owner for investing capital in the business. So from business point of view, interest on capital is a loss, is a expense given to owner. Then it will be recorded in profit and loss account debit side, and the second effect, it will add the capital of the owner as he is getting the interest on capital. So second effect is we will add interest on capital in capital under balance sheet. Then the last is interest on drawings. Interest on drawings means interest charged by business from owner. Interest on drawing effect is profit and loss credit side, because from business point of view it is income for the business, so it will be recorded on the credit side of profit and loss. And the second effect is it will be deducted from the capital under balance sheet. We will deduct interest on drawing from capital in balance sheet. Clear? These are few adjustments I discussed. Now see one question related to it. Now see this question: from the following balance prepare trading and profit and loss account for the year ending 31st March 2019 and balance sheet. Information means trial balance is given and these are the adjustment. Now see, closing stock is given. Machinery is to be depreciated 10% per annum. Depreciate patent 20% and salary 4,000 unpaid. Unpaid means outstanding. So how will we show? First adjustment is closing stock. So where we record closing stock? Closing stock is recorded on the credit side of trading account. See, closing stock, by closing stock 16,000 and closing stock on balance sheet you can see over here. See the closing stock, that is 16,000. Clear? Closing stock will be on two sides, trading account credit side and balance sheet asset side. Then second adjustment is machinery is to be depreciated by 10% per annum. Where we record depreciation is recorded on the debit side of profit and loss account. Now see what is the value of machinery. Our machinery is, what is the value of machinery? 35,000. Now we have to calculate depreciation 10% on the machinery. 10% depreciation on machinery, that is 35,000 into 10%, that is 3,500. So depreciation on machinery is 3,500. Two effect of depreciation is, first we will record on the profit and loss debit side, see depreciation on machinery 3,500, and the second effect we will deduct depreciation from the machinery in balance sheet asset side. See, machinery 35,000 less depreciation 3,500 and the balance is 31,500. Clear depreciation. Then the next is depreciate patent 20%. We have to calculate depreciation on patent. What is the value of patent? You can see this is 10,000. So 10,000 into 20%, that is 2,000. So how will we record? We will record 2,000 on the debit side of profit and loss account to depreciation on patent 2,000. In the second effect, we will deduct from the patent in balance sheet patent 10,000, that's depreciation 2,000 and the outer value 8,000. Then the next adjustment is salary amounting 4,000 was unpaid. Unpaid means outstanding salary. So where we record salaries, see, this is salary 14,000. Salary we will record in the profit and loss account with the name to salary 14,000. Then we will add outstanding salary 4,000. Total is 18,000. Now 4,000 outstanding will be recorded on the capital side. On liability side. Outstanding salary, as this is our liability and we have to pay outstanding salary 4,000. Clear? Now we have recorded all our adjustment. Now we will do this question one by one. Items: cash in hand, where we record it on the asset side, cash at bank asset side, purchase trading account debit side, and from purchase we will deduct purchase return, that is return outward. Then return inward we will deduct from the sale on trading account credit side, buy sale less return inward. Then power and fuel trading account expense, debit side of trading account, carriage outward, profit and loss debit side, carriage inward, trading account debit side, opening stock trading account debit side, building asset machinery we have already done in the adjustment, Patent we have already done, salaries we have already done, journal expenses, profit and loss debit side, drawings we will deduct from the capital in balance sheet, then debtors are assets on asset side. Then capital under liability side, creditor liability side and bills payable liability side. You will record all the item, then you will calculate your gross profit by calculating balance from trading account, that is gross profit 32,700. This gross profit will be transferred to profit and loss account on the credit side with the name by gross profit brought down 32,700. Then we will calculate our net profit by deducting all the expenses from this gross profit, that is 3200. Then this 3200 will be added in the capital. In capital we will add net profit and less drawing, then we will get our actual capital, and at last the total of balance sheet will tally. Clear? Thank you.